Good morning, friends. Happy Monday to you. Well, I want to review a couple news topics from last week. First, and many of you might have already seen this, but on last Thursday's Wall Street Journal, the front page, there was a photo of Vladimir Putin with Prince Salman of Saudi Arabia. Putin had flown to Saudi Arabia in an armed escort for the first time in years to meet with Saudi Arabia and United Arab Emirates. They were there to establish ongoing peaceful economic relations and negotiations, and just communicating to the world that they are continuing to work together. Now, all of that happened at the same time last week. There was a international meeting in the UAE, United Arab Emirates, and the host made a loud announcement, and there was a lot of U.S. dignitaries, including our own governor, flew to that. They were there to discuss the global impact of oil and global warming. But at that meeting, kind of made waves because the president made a loud announcement saying, oil is not the enemy, and we've got to quit villainizing oil. It kind of caught some of the American politicians off guard because that's not the message they've been saying themselves, but they were the guests of this host country, so they didn't push back too hard. Meanwhile, here on U.S. shores, what we're seeing is Congress is starting to lose some of the wind out of their sails in terms of the push for electric vehicles. Now, why is that happening? It's not because they love oil, it's because the push for electronic vehicles has been inflationary. It's too expensive. And what they're trying to do right now is pull back inflation. So as they're pushing electric vehicles, it's having a detrimental impact on inflation because the whole program is too expensive. And we're seeing car dealerships now saying, we can't sell these cars, people don't want them, not like we thought they would. So they're starting to pull back, which brings us back to oil. Looks like what Greg and I have been saying, looks like we weren't crazy. Oil is going to continue to be in demand, not only just here in the U.S., but globally. I mean, we're the wealthiest nation in the world, and if we can't afford electric cars, then the rest of the world isn't going to afford them at a greater rate than us. So we expect oil to remain dominant and continue to grow in demand, even if we're not necessarily pumping it on our shores because it's not popular politically. It'll continue to be in demand, and as it increases in demand, the value goes up. Meanwhile, I read another article by a former Federal Reserve board member. She was talking about the Fed's position right now. So last week we saw gold jump up in price. And what I was saying was the market's not necessarily buying Jerome Powell's statement that he's going to keep interest rates flat. So he's saying he's going to play a tough game and keep interest rates flat and potentially raise them, but the market didn't buy it because keeping rates this high is having a detrimental impact on the economy. Meanwhile, Jay Powell is saying he doesn't want to create a recession, he wants to create a soft landing. And so the market's saying, well, then he's got to have to lower rates, which means gold was going to shoot up. So they jumped the gun on that, gold jumped up. This former Reserve Board member was saying that she doesn't think it will because she doesn't think Jerome Powell is going to lower rates. She does think he's going to keep them there for a while or raise them. One of the key elements that just was reported that supports that position is the jobless report. Unemployment shrank. So when unemployment is low, that means people have jobs. Now, you and I love that. We love seeing people going to work, earning money, spending money. But when you're trying to bring down inflation, that doesn't help bring down inflation. In fact, it continues to exacerbate the problem because people are making money and spending money, making money and spending money. And so the inflation continues. And Jerome Powell has basically said he needs unemployment to grow. that's when he'll start to take his foot off the brakes. And so the fact that unemployment is not growing, that employment continues to stay strong out there, means that he's probably going to keep the rates higher for longer. What does that mean for the markets? Well, the stock market will continue to strain under that because these companies have debt that they now have to pay at higher rates. Consumers have higher debt payments that they have to make, which means they can spend less out on in the market. And so it tends to point to what I've been saying for a while, which is that this whole notion of a soft landing isn't going to happen. It's going to be a hard landing, a normal recession, if not a doozy of a recession. By the way, I will say the Fed has never accurately predicted a forthcoming recession. In fact, Ben Bernanke, who was chair during the Great Financial Crisis, the Great Recession, in 2007, he said, "We've got this under control. We're going to have a soft landing." And we all know how that went. So with that, I'm going to leave you with that. And in terms of your investments, so if stocks continue to go down, that money's not just going to disappear. The money's going to transfer. Where is it going to transfer? Well, we're of the mindset that it's going to be transferring into real assets, hard assets, things that can't file bankruptcy, things that don't necessarily strain under higher interest rates, which is our investment strategy in your portfolio. So with that, I hope you all have a great rest of the week, and we'll see you next week. Take care. Bye-bye.